Welcome to the Flow Tracy Monday Daily Commentary. This is Owen Tracy recording, and it is 4:51 p.m. and that is Central Time, and today is November 15th. Well, we had fireworks yesterday and a much quieter day today, where Wall Street was up but only marginally, and then bond prices, having rallied very significantly yesterday, were a bit weaker and yields were a bit higher. Gold, having popped on the upside yesterday, was down a bit in here today. So then also the dollar, which had really fallen precipitously yesterday, was also a bit steadier. When we think about Asian markets, they followed through on the upside with the big move on Wall Street. We had a positive return in the vast majority of Asian markets, Wall Street, and then Europe was also in positive territory. Then in the energy markets, where oil prices were negative yesterday, again, not a very big day in here today, but natural gas was up. So I think what is happening in natural gas is quite interesting, that a little bit of colder weather in the US Northeast and the price jumps quite impressively, but it was down yesterday. So I think we've got a reasonably balanced market. But then, of course, there's the question, is this $3 level going to hold relative to the lows that we've seen at several points over the last few years around $2? PPI figures came out today and they were also weaker. So we had lower CPI figures yesterday, PPI figures lower in here today. And I think that sapped some of the enthusiasm around stocks. I think what happened yesterday was a lot of short covering went on, and we didn't have a lot of upside follow through today, but not any big declines either. But in after hours trading today, then we had Cisco's earnings, and they were quite a bit below what was expected. So the share is down something like 16% in the after hours. And it really does help to, I think, reinforce the point that there's only so much money around, and that not every company can beat its earnings expectations in an environment where the availability of cash is being constrained by the quantitative tightening process. So that, I think, is where the big point of tension is within the market, because there is the clear conclusion from the perspective of stock market investors that not only are we at the peak of the interest rate hiking cycle, but also that interest rates are going to come down soon without there being any material impact on growth, company earnings, or employment. And that seems almost Pollyanna-ish to the point of ridicule. Well, then there is the alternative, which is that the Federal Reserve is in fact going to do what they say they're going to do, which is that they're going to continue to hold rates at a high level until they get inflation back down to their target of 2%. And of course, then the question will be, what definition of inflation are they going to use for that 2%? But then we have the potential from that outcome would be that if they're going to wait for that amount of time, then the knock-on effect of higher interest rates and constrained creditor availability will be higher unemployment, much lower growth, and then a collapse in inflation.